Welcome. This video discusses recent developments in the U.S. stock market, focusing on the latest financial results and outlook of major publicly traded companies. The information presented here reflects analysis and opinions about publicly available data and corporate results. It is not financial advice. Investors should conduct their own research before buying or selling any stocks in the U.S. market and should make decisions based on their financial situation, goals, and future expectations. The latest results from Oracle Corporation led the stock to rise about 10% after the announcement. The company reported results for its third quarter of fiscal year 2026, since its fiscal calendar differs from the standard calendar year, which is common among large corporations. One of the most important indicators reported was remaining performance obligation, RPO, which reached $523 billion. In the previous quarter, the RPO stood at $455 billion, and in the second quarter, it was only $138 billion. This sharp increase highlights a significant surge in demand for the company's services, especially cloud infrastructure tied to artificial intelligence workloads. The data indicates that demand for cloud infrastructure, especially related to AI applications, remains extremely strong. A substantial portion of this backlog is associated with contracts connected to AI infrastructure clients, including partnerships linked to OpenAI. Although OpenAI represents a major part of the backlog, it is not the only contributor. Historically, the company took on significant debt to finance large capital expenditures for data center expansion. This strategy created concerns among investors who feared that the heavy spending required for AI infrastructure could strain the balance sheet. These fears contributed to a major decline in the stock price from its peak of 272 to around 149, representing a drop of roughly 48% over 6 months. Another factor weighing on investor sentiment was the shift in free cash flow. The company reported negative free cash flow of $24 billion in the last quarter and expects capital expenditures to reach approximately $50 billion during fiscal year 2026. These large investments are primarily directed toward expanding AI-focused cloud infrastructure. Despite these concerns, demand for the company's cloud services continues to grow rapidly. The company appears to be positioning itself as a major provider of AI cloud infrastructure. The main question for investors is whether the debt taken on to finance this expansion will ultimately be justified by long-term returns. The recent 10% rise in the stock appears linked to stronger than expected results in guidance, which helped reassure investors regarding the company's financial strategy. Additional confidence came from the company's recent capital raise through both bonds and newly issued shares. Recently, the company successfully raised more than $30 billion in debt. Demand for these bonds was very strong, with institutional investors subscribing to more than the amount initially offered. The oversubscription of the offering indicates that large investors remain willing to provide capital to the company, despite concerns about rising debt levels. The company is targeting revenue of $90 billion for the next year. Even with heavy capital expenditures, operating margins remained around 32%, which suggests that the core business continues to maintain strong profitability while expanding infrastructure capacity. The ability to raise $30 billion within a few days through bonds and new shares suggests that institutional confidence in the company's long-term strategy is gradually improving. At the same time, the strong growth in AI-related demand supports the long-term growth narrative around its cloud infrastructure. From an analytical perspective, the company's aggressive investment strategy introduces volatility. High capital expenditures and rising debt can pressure the stock price in the short term, especially if investors remain cautious about returns on these investments. At the same time, the strong demand for AI infrastructure, the significant growth in remaining performance obligations, and the successful debt issuance provide signals that the market may be starting to regain confidence in the company's long-term expansion strategy. Based on the available numbers and outlook, the recent 10% stock increase appears justified by the reported results, the fiscal 2026 revenue target of $90 billion, and the successful capital raise of more than $30 billion. However, the company will likely remain volatile until it either reduces debt levels or demonstrates clear returns on the massive investments being made in cloud and AI infrastructure. Until such returns become visible in financial results, the stock could trade sideways unless exceptionally strong growth numbers continue to emerge.
From an analytical perspective, the company appears to be an attractive investment opportunity at current levels, but it may not fit the profile of a stable, top-tier large-cap holding due to the current scale of capital spending and leverage. If you want to stay updated on the latest developments in the U.S. stock market and the financial results of major companies, make sure to subscribe to the channel to receive all the latest updates.